I want to talk about exchange-traded funds, ETFs. I want to give a pretty detailed analysis of them. I want to think about initially what they are, what makes them different, then what kinds they are, how you can, invest in different kinds, then what specific things that are really interesting within ETFs that are very helpful for somebody that owns an ETF. And finally, I want to talk about in detail, like how I use ETFs, not only to like say, for example, to be able to gain market exposure, but to be able to understand how the market's moving and what's going on and what information I can gather from looking at these ETFs in an analytical way. So today, let's talk about like the specifics of an ETF, an exchange-traded fund. What are they? They've grown like crazy over the last 40 years. So the difference, like when I started trading, we didn't have ETFs. What we really had back then was all mutual funds. And you could identify a mutual fund. You could have it a passive fund, an active fund. You could do whatever you want with it, different kinds you could buy. But that's what they were. They were mutual funds. They gave you exposure into different industry classes, into different investment styles, but they were expensive. So let's just look at the difference between an exchange-traded fund now and a mutual fund now. Mutual funds are still really, really big. So if we just do these concentric circles, okay, the things they have in common, both obviously pool money from all sorts of different investors into the same basic pool of assets. And that pool of assets is what we can see how it prices all the time. Both provide diversification. So when you're in an exchange-traded fund, you have a bunch of stocks within that fund or a bunch of bonds within that fund, whatever it is, a bunch of commodities. And the same thing for mutual funds. They both do the same thing. And they can do it with different investments, different investment styles, that sort of thing. Now, what separates them is that you can trade an ETF all day long, okay? You can buy them and sell them all day. You can't do that with a mutual fund. You also typically have passively managed funds. So when you buy an ETF, say you buy the SPDR ETF, you know exactly what you're getting within that ETF, and they constantly rebalance to make sure that whatever is in that ETF stays within that ETF, regardless of whether the price goes up or down, whether there's additional investments in it or additional withdrawals coming out of that, redemptions. And then obviously the prices move all day, so you can buy them and sell them at different prices during the day. Mutual funds, you only buy one time at the end of the day, you buy them. And they're priced by the close of the previous day. And typically those mutual funds are actively managed. So that's the difference between an ETF and a mutual fund. Plus the fact that ETFs have much, much, much less cost to them, mostly because they're passively managed and not actively managed. So when we look at the expense ratios of some of the largest ETFs in terms of asset sizes, you can see how small they are. A lot of times a mutual fund might have 1%, 1.2% fees annual during the year, but these are down to 3/100ths of 1%, 9/100ths of 1%, really small. Here's some of the biggest ones we've got, and you can see that the biggest ETFs, okay, are basically the overall stock market, whether you're getting the S&P 500 or the total stock market. And that's because a lot of people want diversification. They don't want to have to pick a stock. They don't want to have to pick an industry sector. They just, if the stock market goes up, I want to be in, and I don't want to have to pay a lot of money to be in. It's a great thing for them. There's also big ETFs in bonds and emerging markets. The same thing for emerging markets. That's a lot of times what people say is, okay, I know emerging markets is a great area to be in, say 7 out of 10 years, but I don't know if I'm supposed to buy South African stocks, Korean stocks, stocks from South America, European stocks that are from the Eastern Europe, Russia, anything. They just don't know. So what they say is, get me into an emerging market fund or an ETF, and I'll be able to participate that way. Now, if we look at ETFs, remember I said they were all basically passive? So you can see like the difference between active in blue and passive in orange. So obviously all of these ETFs are predominantly passive. And one of the reasons that that is the case is because within that, they can keep their costs down as long as it's passive. They don't have to do a tremendous amount of work. If we look at the top two managers of U.S. listed ETFs, Vanguard was the original and they're the biggest, and then BlackRock is now second. And you can see what happened between 2020 and 2021, how big the growth was. Vanguard went up 50% and BlackRock went up almost 50%. So remember that 2021 was a really good year for stocks, and they saw a significant amount of inflows into their total ETFs. So why are ETFs so popular? You can trade them all day long, so you can identify where they are and how the returns have been for that day, okay? So you can get in and out of an ETF just like you can get in and out of a stock during the day, okay? They provide great diversification, so you can build a portfolio and you don't have to buy all the individual stocks. You can build a portfolio within a sector or within an investment style or within basically a class of investments. Transparency, you can look on the prospectus, say, for example, if you want to, and you can find out exactly what stocks they own and what percentage of the total value of that ETF that stock might be or that bond might be. And so you can identify that, say, for example, I'm buying an ETF and Apple is 6.7% of this ETF. Well, it's going to stay 6.7% regardless of asset inflows or redemptions. They're going to constantly rebalance that. But otherwise, it's going to stay at 6.7%. So, and they're really, really low fees. So when you think about an ETF, a lot of people buy them because they can transact into the market, they can get what they want, and they know they're not paying a lot to be able to do that.